Hey guys, welcome back. So today in this video we're gonna talk about arbitrage trading, and we're gonna see what is arbitrage trading. We're gonna go through its definition, its working, and how you can do arbitrage trading if you want to. And after that we're gonna go through an example in order to understand how you can do arbitrage trading in order to make some profit. Okay, so first of all, let's go through what is arbitrage trading. So basically, arbitrage is simultaneous purchase and sale of same asset in different markets. Okay, and what you do is you basically buy an asset from one market or one exchange and then sell it to other exchange. Now you might be wondering, where would be your profit? So basically you benefit from the difference in price of the same asset in two different exchanges. Okay, so what you do is you basically go to an exchange which is selling the asset at lower price, and you buy it from there. Okay, and then you take that asset to the second exchange, which is basically buying it at a price that is higher than this, okay, from which you bought, and you basically sell your asset at this exchange, the second exchange. And so the main key points are basically the arbitrage is simultaneously buying and selling of an asset in different markets to exploit the tiny differences in prices. Okay, and arbitrage traders can do arbitrage trading in basically stocks, okay, commodities and currencies. There's a benefit of arbitrage trading as well, that is basically arbitrage trading takes advantage of inevitable inefficiencies of market, and what it does is it increases the efficiency of trading markets so that the price differences of assets don't go too far from one another. Okay, so let's go through an example in order to understand how arbitrage trading works. Okay, so first of all, let's say you go to first exchange, and what you do is you basically buy an asset from here, and let's say the worth of asset, or you pay $1,000 in order to buy that asset. Okay, now what you have done is you have taken an asset which is of $1,000, and then after that what you will do is you will buy it and then you will sell it in another exchange or other market, which is basically buying the same asset at a little bit higher rate. Okay, so then you go to your second exchange and you sell this asset which you bought for $1,000 on this exchange for let's say $1,005. So what you did here is you basically bought an asset for $1,000 and you sold it on another exchange for $1,005 simultaneously. Okay, and price difference of these two exchanges is what you have made in terms of profit. So basically you have made a profit of 5 USD here in this example. Okay, and so you, after selling it for $1,005, you basically recover your initial capital and then plus you take your profit home. Okay, arbitrage trading provides a mechanism to ensure that the prices do not deviate substantially from fair value. Okay, so that like there's no case where like one exchange is selling an asset for $1,000 and another is selling it for $1,500. That would be crazy, right? So arbitrage trading takes control of that, and it reduces that risk, or it reduces the price differences between markets. Okay, and with the advancements in technology, it has become extremely difficult to profit from the price errors, okay, in markets. And what you would need in nowadays in order to do arbitrage trading profitably, you would be needing highly advanced systems and softwares which would detect the price differences between markets and then automatically buy from one exchange and sell it on another exchange or market. Okay, and those systems are set to monitor the fluctuations in similar financial instruments, and any inefficient pricing setups are usually acted upon quickly. Okay, so if it found that this market is selling an asset for $1,000 and another one is buying the same asset for $1,005, the system would quickly and instantly buy it from here and sell it on this market in order to give you the profit. Okay, but those systems are very complex and very expensive. Now let's go over an example in order to understand how traders basically make money from arbitrage trading in forex. Okay, so let's say you start with an initial capital of $2 million. Okay, I know that's a big amount to consider, but many big firms and big traders do have that much capital, and they start with these and they play around with these big funds, and that's how they make their money. Okay, so let's say in the beginning you have a trading capital of basically $2 million. Okay, and what you do, first of all, you have $2 million, and at the one exchange or one bank, you see the transfer rate of your USD at 0.894. Okay, so you convert your $2 million into 1.788 million euros. Okay, so basically your $2 million dollars have been converted into 1.788 million euros at a rate of 0.894. Okay, now in your account you possess, instead of dollars, you possess euros. And what you will do next is you will go to the bank B, and then you will take your euros and convert them into pounds. So let's say the transfer rate of pound is currently GBP euro rate is basically at 1.276, and when you convert your euros into pounds, you will basically get 1.401254 pounds in your account. So first what you did is you converted your dollars into euros, and then you converted your euros into pounds. Okay, now you should be able to see the effect of this or the profit from this trade once we convert the pounds back into our original currency, that was your US dollars. Okay, so after that, first step, you convert your dollars into euros. Second step, you convert your euros into pounds at a rate of 1.276, and then what you do is you basically go to the third exchange where you convert your pounds into United States dollars, which is what you started with. Okay, and now because of the different exchange rates, what you have done is when you convert your 1.401254 pounds into United States dollars, you're basically going to get $2,006,596. So between these conversions happening, what you did is, from exchanging money from one currency to another and then reverting it back to your original currency, in the end you basically made a profit of $6,596. Okay, so basically when you convert your 1,401,254 pounds into United States dollars at the rate of 1.432, you basically get 2,006,596. And when we subtract this 2 million from our final amount, which we ended up with, you basically get a risk-free arbitrage profit of $6,596. So your starting balance was 2 million, but your ending balance was 2,006,596. Now again, this might sound very simple, but as I said earlier, that these types of pricing or fluctuation errors are very, very rare these days. Okay, with the advancement in technology and everything going around, it's very difficult to make profit from arbitrage trading nowadays with small capitals. Okay, and you would basically need very, very sophisticated softwares and high intellect individuals or traders in order to make profit in this arbitrage trading. So I hope you liked this video. If you have any questions, please comment down below and I would love to answer them. And you can also visit our website www.forexb.co in order to learn more about price action, and see you guys in the next video. Thank you.